I think just to honor and respect all your time, I think we're going to kick off. So yeah, just for those that don't know, it's Tom's birthday again. Tom, great wishes from the C team and everyone. Just hope you have an awesome day, bud. Adrian is unfortunately not available today, so I'll be hosting. Huge welcome to you all. If there are any questions, please pop it in the chat box. I'll be monitoring that, and if there are questions, I'll interrupt the speakers if I feel it appropriate. Otherwise, we'll handle questions at the end. You've joined. I think I don't need to tell you what's going on in the world at the moment. It's really a crazy time. With the Russia-Ukrainian situation, with the Chinese tech sell-off that we've seen. Fortunately, today there's been a massive rebound. I mean, you can't actually understand the percentages. Ian was saying earlier that Tencent is up over 20% today. These are volatility we haven't seen in years and years. We have the Fed interest rate decision this evening, which has got the US markets jittery for some time now. So we'll get some clarity on where they're going with regards to the inflation battle. And through all of this, our regulators slipped in an easing on the Reg 28 offshore allowances, which is sort of kind of been lost in the noise of Ukraine, Russia, and everything else that's going on in the world. So we're going to be touching on a lot of that. We're going to hear from Ian around the market, and then Mark will give us an update on some changes we made in our funds. And Tawanda will talk about our manager research, and in particular, we'll be focusing on that Reg 28 amendments. So yeah, without further ado, I'm going to hand over to Ian.
Yeah, great, Sean, and yeah, good to be with you guys again. So what I thought is, I've just got two slides, and we sort of thought, let's put into a bit of an infographic, and you know, maybe you guys can potentially use this. I mean, and hopefully it might be of use when you're sitting in front of your clients. So the two slides are effectively, the first is just investment risks, and you know, almost by definition, you know, we obviously try and set out what we see are risks, and obviously these are things that are actually in the market, so to speak, at the moment. So almost by definition, you know, the risk is what's sort of left once you've thought you've covered everything else. But these are the sort of things that are definitely pervasive at the moment. So if we take from left to right, and we sort of put it on a little bit of a scale as well, but there's no science behind that whatsoever. So we've seen the global equity and the bond market. The bond market is a big factor. We all tend to focus on the equity market, and we've seen equity prices come off dramatically. On average, across the globe, MSCI equity 12% or so year to date. Obviously, we've seen bigger moves in selected indices and selected shares. But the bond market is the big one, and that's the one that is obviously concerning. We look to corporate bond yields and also the 10-year. The 10-year now is above the 2%. It's about 2.18% today. So it's actually is a concern. If we take back 2 years, the market had a huge sell-off. Global bonds, i.e. the US Treasury, went to 0.5%. So we've come up from 0.5% to over 2%. Clearly, the concern is the next point there, global inflation. So this is the big one. You know, reaching in the US and globally, you know, multi-decade highs, 7.9% year on year. These are numbers that the US has not seen for 40 years. And this is even before the oil spike up in March. Obviously, we saw the big spike up. We've seen the price come back down again to just over 100. But a huge amount of volatility in the underlying components. So global inflation is the big concern, because what happens is that obviously feeds into the next point, which is central bank policy. And as Sean mentioned, I mean, tonight the Fed is today they're meeting. We'll get the announcement sort of tonight, 8 o'clock or so. What are they going to be doing with respect to the interest rate? They have telegraphed and have been telegraphing for a while now that they want to raise rates, that they need to raise rates and stop the quantitative easing. So they're slowing down and have pretty much, I think, virtually stopped the quantitative easing. And we're going to just have to see what happens. I mean, typically with those type of inflation rates, they should be putting up the interest. I saw some report which said actually it should be at 1.75% jump from a zero base. But is it going to be 0.25%, 0.5%? Whatever it is, if it's 0.25, I think the market will take it in stride. Potentially, even if it's 0.5%, might have a bit of a jitter. But they are way behind the curve and in terms of the inflation. And it's not necessarily going to be stopping inflation, because this inflation is, as we know, coming from supply shocks. So this is the quandary that the sort of global monetary authorities find themselves in. You know, you've got these huge amount of money printing that we've had over the last couple of years, and that's coming into contact with a huge amount of supply shocks. And that sort of feeds onto the one we've sort of painted in red there, which is obviously the geopolitical environment, which is obviously really reared its head now with the Russian invasion into Ukraine, which is clearly a huge humanitarian crisis. It's not the only one around the world, but it's obviously super topical at this point in time, and clearly having a massive impact. You know, I've put some stats there. I mean, it is interesting. Russia is not a huge economy, but it does sort of punch above its weight in terms of its commodity supply. So it's actually quite interesting as the second biggest oil supplier, and that's actually even ahead of Saudi Arabia. So it's a huge oil supplier. It's the world's biggest gas supply, and obviously that is, as we know, feeds into Europe largely. It's a big supply of metals, platinum and palladium. The next big point is, as we know, is you know, food and fertilizer. So it's a huge supplier of wheat, especially the two countries together, Ukraine and Russia. But I think importantly, it's also a big supplier, especially Russia, of fertilizer, and you know, that's going to definitely be felt around the world, and feeding into food price increases and potentially food shortages. And so, you know, certain countries are obviously hugely affected, especially Middle East countries are supplied a huge amount of food from Russia, Ukraine. And then we've obviously got the escalation of the geopolitical risk in China. You know, this is just ongoing. And, you know, we get some quite very detailed reports coming from BCA. We actually, you know, look to their geopolitical analysts as well. And really, I think what we're seeing here, you know, and I was listening to someone, again, one of their geopolitical guys, and actually this is just an indication, or one of the signs, so to speak, of the sort of fragmenting of the world. So, you know, up until this point, or even a few years ago, we sort of reached sort of peak globalization, and now we're moving to the sort of multipolarity world, so to speak. So it's going to have an impact longer term, and we're going to what we're starting to see now is just the sort of shakeout, so to speak. This is a bit of a change in the world scene. So we'll have to see how this plays out. It's hugely topical, obviously. So these are the risks. I mean, there could be a whole lot more. The risks, as I say, are the ones that we don't we even know are coming, so-called sort of black swans. At the same time, you know, we have to look to the opportunities, and for every crisis, we have to try and figure out, okay, where are the opportunities? So again, I think the commodity prices spiking up has been positive already through last year, and continues to be positive for South Africa as a commodity supplier. So we have seen our markets being held up reasonably okay because of the commodity exporting companies. Not only the super profits they make, but I mean, then it spins into other things like the royalties and tax they pay. But we've seen obviously huge run up in prices, obviously, as that is constrained. So palladium, iron ore, coal, those are sort of 3-year average numbers. And so that is absolutely positive for SA. It's definitely positive for the rand, because our trade is positively impacted. Obviously, oil is a negative. We have to import oil. It's our biggest import, is clearly the oil price, is oil. So that's a negative, and so it's fantastic to see that coming back in price, and hopefully that is going to, you know, we see some stabilization. Obviously, even at those commodity prices, there's going to be a degree of stabilization. But clearly, we do benefit, not to the full extent, because unfortunately we have constraints with Transnet and the ports. So not, we're not maximizing it, but it is hugely beneficial. The second one is gold. We're sort of saying there, we've discussed this. I mean, we've got gold in the different portfolios. A lot of fund managers have got a bit of gold. It's played a reasonable hedge against the sort of market turmoil. It's up around about 7%, maybe a bit less now today as we speak, year to date. We would have thought it would be a better hedge given the massive turmoil in the world and the geopolitics. But it's a reasonable hedge. When everything is crashing down, asset prices are crashing down. It's a reasonable hedge. But yeah, we would have maybe thought we'd see a little bit more out of it. But we continue to hold it, as do a lot of fund managers, and I think it's wise to do that. And then what we're saying as well, given the price declines, the huge price declines, while that is a risk in many ways, because you get margin calls and the markets move in trends. Clearly, for money going in, there's a degree to which you want to come in at cheaper prices and cheaper valuations. And that's not to say we've reached the bottom. As Sean mentioned earlier, I mean, there's no question. I mean, it's just crazy moves that we've seen, and especially the likes of some of these. Obviously, we've seen the Russian shares go down to zero. Fortunately, as South African investors and our investors, we had very, 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 very little exposure through the funds to Russia, so that's been okay. But clearly, the big one has been the 10-cent move, and obviously that's affected us process. With 10% decline and then a 23% up move today. I mean, these are just dramatic moves. But all in all, I think it's important that there's definitely better value on offer. That's not to say that it can't go a little bit cheaper, because the valuations are not necessarily screaming buys, especially against the backdrop of higher interest rates, high inflation, and the geopolitical risk. And then the fourth one, we've obviously spoken about this a bit, and clearly it's coming through. A lot of fund managers that continue to hold this, and that's the bond, especially on the SA side. So obviously, we're lending to the government. These things do feed upon itself, because clearly the commodity prices have saw a positive boost to the finances of the government. If it continues, that's a huge tick that will say, the foreigners will start saying, let's also start nibbling at some of the bonds, because they've been big sellers. They haven't necessarily come in yet. And so you're getting 10% yields, pretty decent in a world which is not giving you any yield. The one sort of caveat there is that we continue to watch, which is your base rate, which is your US bond yield, because if that spikes up dramatically, and it has been moving up a bit, that's a bit of a negative, so to speak, for SA bonds. So far they've been okay. I mean, the bonds haven't done much this year, but you're buying into a 10% on average for a 10-year duration bond. And so lending to the government, if the government finances are not great shakes, but if you look around the world, they're not bad. And as I said, it's definitely linked to the commodity prices. And we've seen our strong rand, and that's a direct link back to the commodity prices. I think later on we might have a chart just on that sort of correlation. So that's just in 2 slides, a little bit of the risks. We know the risks. We think we know the risks. There's always something that come left field, but we've got to look for the opportunities. And these are some of the sort of opportunities on the local and global front. So I'll leave it there. 2 slides. Hopefully you guys can use that as well as a bit of infographic. And yeah, if we've got any questions, happy to chat.
Great, thanks, Ian. I think that's a good summary. There's risks, but there's also opportunities, and I guess it depends on where each client is currently invested as to whether they can realize and take advantage of the opportunities. So, Mark, we're going to head over to Mark now. We'll just give us an update on some of the changes we've made within some of our funds. Mark?
Thanks, Sean. How's it, guys? Good to see you all today. So basically just starting off, a lot of you guys are supporters of the seed income fund. And as you've always said, as and when we do make larger changes within our portfolios, we will communicate those through to you guys. At the end of February, we made the decision, but at the end of February, we initiated a change in the portfolio, taking out the Coronation Strategic Income Building Block and replacing it with the Ngwedi Active Income Fund, which actually sits under Tawanda's Manco now. On the left-hand side of this chart, you can just see the holdings of our portfolio at the end of December versus the end of March. So it's a pretty much a straight swap of the Cora Strat Income out and Ngwedi Active Income Fund in. And I guess just the rationale behind it, we've been invested in the Cora Strat Income Fund for 4 odd years. Risk-adjusted performance hasn't been great. We have engaged with the portfolio manager from time to time, and beginning of this year, engaged with Nish and his team again, just to try and understand their portfolio. They are a big ship. It is the biggest fund in the category. It's being managed conservatively, but it's still given us multi-asset within the income fund or within the income space. They are making use of instruments that bring a bit of volatility into the portfolio, and it didn't really fit in terms of how we manage the seed income fund. So within the seed income fund, we like to either have sort of higher yielding strategies, which can take on a bit more volatility, or low volatility strategies, which we can potentially give up some yield, and they're kind of sitting a bit in the middle. Maybe before I carry on within the seed income fund, we do remain happy with the Cora Strat Income Fund as a building block for you guys. I know it is still on our buy list for people who want to make use of the seed income fund that is maybe active and will shift between the portfolios. I guess that has been our preferred entry point. But I don't think there's what we want to make sure is there's no panic. You don't need to sell out of your Cora Strat Income Fund if you do have exposure there. But over time, if you're wanting to, if what I said makes sense to you and your clients, you could maybe on review look to see whether the Cora Strat Income Fund still makes sense. So that fund was maybe disappointing slightly, and I guess the question when managing a fund is there's always two parts. We've got to sell if we're wanting to sell something, you've got to replace it with something, and you want to replace with something that you've got a high degree of confidence that's going to do better for the portfolio. If it's kind of just going to keep the portfolio in the same place, we'd rather stick to something that we know a lot better. So on the Ngwedi Active Income Fund, so Farzana Bayat was a portfolio manager at Prescient for a long time. She was part of the walkout to Ngwedi about 4 or 5 years ago, and the reason why at the time we put the Prescient Income Provider Fund on a watch list when the team left was mainly because she was such an integral part and key part of that team. We've always backed her. We've rated her for a long time, and when they moved to Ngwedi, we had a few sort of introductory meetings with them, and while we liked the team and we liked the setup, it was just a very new firm. I think their focus rightly needed to be on business side, trying to gain new mandates, make sure they could continue as a going concern. So we wanted to give them some time to settle down. We kept in touch with them, and then early 2021. That was a year or so ago. Tawanda acquired Ngwedi. We have made use of Tawanda funds, mostly via the Ned Group best of breed range for some time. It's a company that we like, we're confident in, and so the two teams joined. Essentially, Ngwedi, the skill set that Ngwedi brought into Tawanda was great. The institution that Tawanda is and their risk management process and framework brings some comfort into how this fund is being managed. So we had a few meetings with them, got a lot of comfort in terms of how this portfolio is managed, and by shifting from the Cora Fund to the Ngwedi Active Income Fund, we're able to both increase the yield of the seed income fund by around 0.25% and reduce the daily volatility. So what Ngwedi does that Coro hasn't been doing is that they've got a significantly higher yield in their portfolio, but at the same time, they've got no duration. So the return profile is very smooth, and their credit exposure is also very low. It's very minimal credit exposure outside the SA Bank. So it's not like the Fairtree portfolio that's going into a whole bunch of credit. So for us, we maybe had a few more meetings than we would otherwise to completely understand it, because it kind of sounded too good to be true. But we do get their portfolio on a daily basis. We have full see-through in terms of how they're managing the portfolio, and given that it adds 0.25% to the seed income funds yield, in an environment, as Ian said, we've got higher inflation, we've got low interest rates. In South Africa, your cash is probably giving you around 1.5 to 2% behind inflation. So for those investors that require a lower volatility portfolio, but still need to beat inflation, cash or money markets not doing it, and we think that seed income will play a key role there. Then on our asset class views, we obviously update you guys on this from time to time, and I guess dovetailing into what Ian said, local bonds, global equity, those are two asset classes that are still attractive. I guess the local bond side, the yields have kicked up of late with this a bit of this latest volatility, but at the same time, the government fiscus has been a lot stronger with the commodity prices being really firm. Global equities valuations are a lot better. We've still got a lot of attractive businesses that are held, companies that are resilient within our global equity bucket. And then on the local equity side, again, valuations are attractive. There will be a wide, I think, disparity between the different portfolios. So active or stock selection is important, and that is something that we continue to monitor. But I think that the key thing is that with all three of these asset classes, while they are attractive in their own rights, none of them is a complete slam dunk. So what we want to make sure is that within each of our portfolios, we get the balance right. We don't want to put too much into any of these asset classes, should our thesis not hold out. So we try to get the balance right between the three asset classes, given the risk profile. So for instance, in the balanced fund, we are about 10% overweight equity in total, about 5 each on a local and global. Whereas in the stable fund, we're a lot closer to our equity benchmarks, but have a much higher overweight to bonds, given that the stable fund wants to outperform inflation plus 4. You've got inflation plus about 4.5 coming from your government bonds. So that really matches what the mandate is. It's got a much greater probability of protecting capital than equity. So within the different portfolios, we'll tilt between those assets given the risk budget. On the unattractive side, we've got local and global cash. We do expect rates to rise both in SA and globally over the next year, maybe 2 years, obviously depending on how the economy goes. But despite these raising rates, yields remain at historic lows, and with the high inflation, you essentially are locking in negative real yields. So again, going back to the seed income fund, I think where not only the seed income fund, but that multi-asset income category, those funds are typically able to generate yields that are above inflation. So for a long time, South Africa has been very fortunate in a way for people at the low risk portfolios, that you could just put your money in money market and beat inflation. We're not in that position at the moment. So you do need, for clients who've got that lower risk, to potentially push out a little bit, go into multi-asset income funds, taking maybe a bit of credit, a bit of duration, but pushing up that yield and at least matching inflation. And then I've kind of dubbed it as the wild card, the Rand. We know there's various factors that influence where the Rand goes. There's a lot of, political dynamics around it. But purely from an economic side, what I've done here is I've tracked the CRB index. So that's the Commodities Research Bureau index. It's a basket of commodity prices. To make the chart look a bit, to make it work a bit better, I've inverted that. So essentially when that line from March 2020 has been coming down, that's essentially commodity prices going up. and going up strongly. And what you can see is that the rand dollar exchange rate tracks this commodity basket very closely. When I did the regression, the price of this commodity basket actually determines 70% of rand movements. You can see from time to time the rand does over and undershoot, but purely looking at this, and if commodity prices remain firm, this is saying the rand could maybe be at 8 rand. I don't think for any second we are forecasting that. We think the rand's probably close to fair value at the moment, but it is something that sits at the back of our mind. And I guess when we go on to the next slide and we talk about the changes to the Reg 28, I think for clients, maybe a year or so ago, the rand was probably fair value against these commodity prices. But with the commodity prices really rocketing up over the last 12 months, where it used to make sense to externalize a lot of the clients' assets that are outside of their retirement portfolios. That no-brainer maybe at the moment is not so much of a no-brainer. So just maybe take it a bit more, have a bit more of a thorough look at that. And then finally, from my side, just a quick snapshot in terms of the Reg 28 changes. The global allowance, I'm sure you guys are all aware, it went from 30% plus 10% Africa to 45% total global. I actually had a chat with Tom shortly after it, and it's interesting. We had a chat with quite a few of the fund managers, and the wording that came out, the budget speech, everyone thought it was kind of shifting up to 35% global plus the 10% Africa. But after a few days, there's clarity made that no, it's actually pension funds can take 45% of their assets offshore. Firstly, I want to say this is a positive signal to the market. I know that, again, there's a lot of doom and gloom about SA, specifically on the political side. Take your money offshore. The government's going to nationalize all your assets. They're going to, in your retirement assets, they're going to tell you can't send any money offshore. That there's going to be prescription of assets and all the rest. But essentially, this is a big change. It does allow a lot of many billions of rands to leave the market or leave the country. And so the government, by doing this, I think it's a positive signal from a political side. From an implementation point of view, there's no doubt that our local funds, so the seed funds, will have a high global allocation over time. Just having a broader universe, it doesn't make sense to necessarily stay invested in a market that's less than 1% of the global market. So we'll look to make use of this higher global allocation over time. But I think key here is that the higher allocation doesn't necessarily mean that we're going to have less exposure to the rand. So particularly in the income funds, a lot of the multi-asset income funds have up to 15-20% exposure globally, but they'll typically hedge out all that currency risk. So there are ways and means of increasing your exposure, but increasing your global exposure, so to global assets and opportunities, but not increasing your exposure to currency volatility. And again, in an income fund, that currency volatility is a major impact. So typically in the income fund, at least 90% of your offshore exposure would be hedged out. And as you move up to a stable and a balanced fund, you probably need to hedge out slightly less. But there are ways and means of doing it. And there are opportunities on the table currently that we are looking at to boost our exposure, but not necessarily externalize the assets and be at risk if the rand does maintain its kind of recent strength. And then finally, I think the manager selection becomes more critical with these broader mandates. Given the sort of broader allowance, managers can increase exposure. We will see a bigger dispersion between the managers. So I think the seed funds are best placed to manage this process. We obviously on top of the managers. For a bunch of them, we're getting holdings on a daily basis. If not, we're getting it on a monthly basis. We're assessing it. We're speaking with the managers, and we're making sure that what they're doing still fits in with how we see the world. Okay, thanks, guys. That's it from my side.
Yeah, thanks, Mark. So, Tawanda, I think you're going to tell us what the managers are saying. So let's go straight into that.
Thanks, Sean, and good morning, guys. So I'm going to run you through what the managers have been saying. I think as the regulation change came in, then we spoke to quite a lot of the managers just to get a bit of their reaction. And what I can say is that from everyone that we've spoken to, this is a very welcome decision that the government made. I think everyone is appreciative of the opportunity. It's a bit of a no-brainer that the offshore offers a lot more diversification opportunities, and that added flexibility in terms of asset allocation decisions is something that all the different managers are very much appreciative of. But the big thing, as Mike has mentioned as well, is just the additional currency risk that comes from a bigger allocation to the offshore. So that's the one thing that the managers have mentioned, that, look, we would love to have a lot more offshore. Over time, we are going to increase that offshore allocation, but we need to be cognizant of the additional risk that comes to the various portfolios. So in terms of the changes that they would make, then they would make the changes if obviously there's better valuation opportunities offshore, but they have to be cognizant of the risks. And obviously, if they're going to make any changes, then they have to be considered changes just because of the additional risks that you're potentially going to get in your portfolios. So like I said, over time, then it's a very much welcome move, and you're going to get all the managers trying to make use of that offshore limit. But in terms of near-term changes, then that's going to be much more considered, and they're not necessarily going to rush to ratchet up that offshore allocation to 45%. So if we just move on to the next slide, just to look at some of the managers and if they're going to make any changes in the short term, in the near term, are they going to make any changes? So there's a bunch of the managers that we've spoken to just to get their reaction, and obviously some of these funds are on the short list, and I've just mainly focused on the high equity category. With one or two of the funds right here not on the shortlist. So to start there, just to look at whether they're going to make any changes in the short term, what it sounded like, most likely the 91 quality team, the team that's managing that 91 opportunity fund, is probably the most likely to increase that global allocation. We know Clyde Rousseau, who leads that team, he loves global equities. He's looking at quality equities, and if you look at that quality investment style, then you don't have as much quality in the South African market. So if we look globally, though, then you've got a lot more opportunities for quality equities. So it would make sense for a strategy like that is looking for global quality to obviously have a lot more exposure to the offshore. So you would most likely look to increase the global equity exposure there. And just in terms of managing that risk, there's always the thinking of risk management. Then you may try to offset that by increasing the allocation to local bonds. And obviously, when you are increasing your equities and potentially increasing that bonds to offset that impact, then that will come from a reduction in your local equities. Prescient is another manager that also sees it pretty much as a no-brainer to increase that offshore allocation. But also in their process, in terms of their strategic asset allocation, all the analysis that they've done is that it makes sense to increase this offshore, but you need to manage that currency risk. So obviously they would increase their offshore exposure as soon as possible, but then they would be making use of currency hedges just to manage that risk side. So you'd probably see, if they go to that 45% limit, then at least 20 to 25% of that portfolio would be currency hedged. Then the guys that sound a little bit more neutral, Stanlib and Ford. So I'm calling it neutral just in terms of the short term. They said they would definitely love increasing that offshore exposure, but there's that whole risk mindset. So they very much mindful of the risk. So they can increase as soon as possible, but obviously managing that currency risk as far as they can. Ford just mentioned that they need to balance risk and rewards and what's currently happening in the global economy. So that's very much important for them. So not necessarily going to rush to increase, but obviously looking at it. And Ford did mention that in the short term, in terms of increasing offshore allocation, if they're going to, then global property would be a very useful asset class for them when they're looking at increasing that offshore. And then I've just grouped together your Allan Gray, Coronation, and Prudential just as the least likely to increase that offshore allocation in the short term. And these managers are very much valuation based, and being valuation based, they find South African assets being much more attractive than offshore assets. So they currently already have a much lower allocation to offshore assets because they've allocated a lot more to the local assets. And just looking at these near-term decisions just shows you how we're likely to get a disparity in terms of asset allocation between the different managers. And like Mike mentioned, that's going to play quite a big role in terms of performance going forward. So whilst we've seen the average manager pretty much perform in sort of like the same range, when you've got a bigger disparity in allocation to either offshore or local, then you're going to have a bigger disparity in performance. So manager selection becomes quite a huge thing. One of the 91 teams, sorry, Lisa, just before we go to that slide, one of the 91 teams see the range that managers are likely to be working with in terms of allocating to offshore as between 35 to 45%. When I spoke to Marius at Stanlib, he sees most managers probably looking at it from the range of 25 to 35 and actually not going to as much as 45%. And speaking to the Prudential guys, their strategic asset allocation, what they see as being the most attractive there is a range of like 20 to 30% offshore. So again, hammering that point that more than likely you're going to see quite different approaches in terms of allocating to this offshore, quite different ranges, and that's going to play a big impact on asset allocation and performance going forward. And obviously, if we look at how the funds are currently positioned, just in terms of their current asset allocations, and I've just looked at the key asset classes here, offshore, SA equities and SA bonds, because that's providing the most opportunities for local managers. If you look at the offshore allocation, I've just highlighted the Allan Gray, Prudential, and Coronation, the valuation based, they find local valuations more attractive, so they allocated a lot more to offshore, a lot more to South Africa. So you can see that they've got the lowest offshore exposure currently, and which is why they're less likely to increase that offshore exposure, because they already have lower than the max 30% that was there. Obviously, Ford and 91 opportunity at the maximum, and present balance. So I said 91 opportunity and present balanced are the most likely to increase their offshore exposure, just given. And if you look at the current offshore exposure, they're rather at the limit or just below the limit. So you can see how they would likely take advantage of that opportunity that's been presented. If we look at the next slide, the SA equity allocation, then again, you can see Allan Gray, Coronation, and Prudential have the highest SA equity allocation. Obviously, local has been is more attractive on a valuation basis. 91 opportunity stands out there, like I said, global quality focused, so you don't find as much quality in South Africa. You see that 32% as the lowest South African equity exposure. And if you look at the year-to-date performances, the funds that have a lot more exposure to or year-to-date and over the last year, South African assets have actually done much better, and that's contributed to performance. If we just lastly look at on the bond side, just that bond allocation, the 91 opportunity also uses the SA bond to offset their offshore exposure. You can see they've got a much higher SA bond exposure. So all of the different managers are looking at that high attractive yield in the local bonds, but obviously have different allocations. So what I can point out there, Allan Gray does stand out at a 10%. They've got the lowest SA bond exposure. They do say that they find SA bonds quite attractive. They like them. So even that 10% is high based on what they historically hold. But then they're also finding better opportunities in South African equities, like the financials. So they allocate a lot more to equities than they would to the bonds. And just to round off on my side, just a quick performance slide. Returns have pretty much been muted so far this year on a year-to-date basis. You know the volatility that's in the markets right now. So I just wanted to point out just a few points, just if we focus on that 1 month or year-to-date performance, just for you guys to see on a relative basis within that high equity category what's been happening. So if I can start by zooming in on the Allan Gray, which has been a top quartile performer on a year-to-date basis, and that's obviously because being valuation based, value has outperformed so far this year, and in opposite or relative to that, if you look at the quality or the quality, which is what the kind of style that 91 Opportunity uses, that is a struggle relative to value. So you can see bottom quartile, your 91 Opportunity because of that quality focus. The SA market, or like I said, having done better, then you can see the guys that have a higher allocation to SA doing a lot better. So the key theme over the on that year-to-date performance is returns have just generally been muted. The funds that have a high allocation to SA equity have done better. Offshore markets in particular have been under a lot of pressure. And if we look at that value versus growth, then value has outperformed. Just looking at that global macro narrative, investors have been worried about inflation, investors are worried about interest rates, and then obviously now you see you've got geopolitics coming into play as well, and all these factors have obviously influenced that year-to-date performance and that relative performance that you see from the managers. And that's it from my side.
Great, thank you, Tawanda. I think it's clear that Mark and Tawanda made the point that the dispersion between asset allocation is going to increase now, and I think from your perspective as advisors, selecting funds is going to become a little bit more tricky. And I think what we're also doing at Seed is we're reviewing our shortlists. We're looking for those uncorrelated blends and combinations. Everything's under review at the moment, and also we're reviewing our existing positions in terms of our Reg 28 allocations. We haven't moved massively at the moment. We've made some small nibbles at increasing our offshore, but we have this strong rand, or perceptually strong rand, at the back of our heads, as Mark said, which is hampering. And perhaps the timing couldn't have been better from a regulatory perspective, that you've got a perceptually strong rand with this increasing allowance, which has prevented a mass sell-off locally and a flood to offshore. I think CityWire put out an article last week estimating that up to 400 billion rand could move, and I think they just took the Reg 28 funds and took a 30% and moved it to a 45%, and that equates to about almost R500 billion worth of investments. But we haven't seen that. We haven't seen that mass sell-off, and that's largely around this currency risk. So I think the selection of funds is going to be really critical for you as advisors, and as Seed, we are here to help and support. We don't have all the answers, but we do have direct contact with the underlying managers, and we know daily where they're moving and how they're moving, and we know what their views and positions are. And as you can see from Tawanda's feedback, it's very disparate. Some can't wait to go. Others see huge value in South Africa still. So now, where do you go? And I think the shortlists and the blends that we put together will hopefully take advantage of that and create a smoother ride for us. Robbie, I see a hand there. Have you got a question? Roberto? No.
think he's on mute.
There we go.
There you
Sorry,
go.
guys. Morning, everybody. Thanks, Seed.
Right.
Sean, yeah, I just wanted to get some feedback from Seed regarding the DFM models, their take on it.
We remain supportive of their models. I mean, they obviously giving updates quarterly, and we are supportive of their models. You know, obviously our funds there's a 10% weighting towards our solution, so there's no reason why we shouldn't be supporting them. But I think the proof is in the pudding in terms of you know, they did the backtesting performance analysis, and it was all positive. The fees, they have knocked the fees down tremendously, which will be positive longer term. So we expect those DFM solutions to perform well, and be in as they would be targeting top 2 quartiles on the appropriate measurement period. So, but yeah, I think we're still supportive, and we're working with the Stanlib team on a consistent basis. There's obviously in those models, there's a greater number of funds included. With our shortlists, we're typically looking at 3 to 4 funds that we're blending, and obviously within the seed funds that are in those blends, it's a multi-manager, so you get accessing an array and range of other underlying fund managers. So, you know, I know some feedback from the field is some clients have balked at just the sheer number of funds. Some are 8 or 10 different funds in a solution, but I think over time maybe they will knock that down. Yeah, no, we're still supportive, and we're working with them. Any other questions? Okay. So if there are no other questions, thank you everyone for joining. Just remember, we're here, we're a phone call, we're a WhatsApp away, an email away. We're here to serve you, and we're here to help you and your client meet their financial goals when it comes to investing. And sometimes, I think our weekly that we put out last week was sit on your hands. We punted that message 2 years ago, and it came to fruition. We're going to continue to punt that message that this is not a time for knee-jerk reactions. And if nuclear bombs do go off in the Northern Hemisphere, there's no place to hide. So even cash will be decimated. So, you know, make sure your clients are in the appropriate risk bucket for their season of life. And if they are, then sit on your hands. If we need to tweak some funds, change some allocations to particular funds, particularly with the Reg 28 changes, it's something you should be looking at with your client reviews, and opportunity certainly for clients to upweight their offshore allocation and exposure. But as we've said quite a lot, that comes with increased volatility with regards to the currency. So yeah, I wish you all the best, and may we see some more green on the screen today.